Say hi, everybody. I'm Howard. This is Otter, and this is Otter's Retirement Corner. Otter had to leave. Otter's more of a behind the camera type personality, so we'll get him back to that. So, welcome. Today we're going to discuss something probably should have looked at it maybe a week or so ago. We're going to talk about 2024 market predictions because everyone's made them. Excuse me. So, how does that affect retirees? How does it affect people coming into retirement? Hopefully, everybody has savings and investments, whether it's 5,000, 500,000, a million, 5 million, whatever it is. Hopefully, you have that. If not, hopefully, you're getting to that point where you're going to have it. And within those portfolios, you also want to have an allocation to stocks. When you're younger, very high. You could have it high as 100% when you're very young. Mostly we're focusing on people, 40 to 80 right now. So prior to retirement, you still want to have a hefty allocation to stocks, 70, 80, 90% even. I would personally be comfortable with that. Once you get into retirement, you're probably, or close to retirement and then into retirement, you're probably cutting back. But most models will show you that the most efficient portfolios are somewhere between 50 and 75% allocation to stocks. And hopefully you stay with that. Now, over time in retirement, people like to rebalance, keep their, say if they start with 60%, they keep it at 60% every year. Some people like to time the market. And by timing the market, I mean they think stocks are going up, so they buy more, or stocks are going down, so they sell them off. History has shown us, research has shown us, that timing the market doesn't work. And certainly there's people out there who have done it, who have been successful, and are continuing to do it, but it's a tiny, tiny minority. You'll also see that most mutual funds or ETFs do not beat market averages over the long term. So personally, I stick to index funds for both stocks and bonds. I do have one disclosure. I do have one individual stock that I've held for a long time. It's Apple. I've sold off most of it, and I still have a ton of it because it's also in mutual funds. It's also an index fund, so it's hard to get away from. But I do own the individual stock. Anyway, all the brokerages and banks and research companies have come out with their predictions. And I'm going to talk about their S&P 500 predictions right now, and what it means to you, and what you should do based upon these predictions. Okay, so here you'll see, and I'm going from the worst predictions to the best predictions. BCA, which is a research company, um, they're looking at a 31% drop. They're predicting a recession late in the year. Interest rates maybe still going up and inflation still going up, so they're very pessimistic. JP Morgan, surprisingly pessimistic. Banks tend not to be very pessimistic because it scares off some of their investors, but there you go. Morgan Stanley, pretty these are based on Friday's closing prices. This would be the change in the S&P based upon Friday's closing prices. So these weren't their numbers at the beginning of the year, but they're fairly close. So, as you see, we got four of them that are pretty pessimistic. And then Davis Research gets a little better. Then you come to B of A, and we're looking a little brighter. Of course, in 2023, we saw the markets go up significantly, 22, 23%, I think, for the S&P 500. And while research will show that following big up years, you also have up years, they tend to be much smaller. So, then you got Goldman Sachs, Deutsche Bank, BMO, they're at 6.6%. That's probably what you expect to see. We got a couple of the more optimistic predictions here. Yardeni at the most optimistic at 12.9%. So the first question is, why do banks make predictions? It's risky, number one, but if a bank can make good predictions over time, they tend to be able to bring in more people to their brokerages and people who will invest with them. The tricky thing is if you predict down 12.9% like JP Morgan, or 12.2 like JP Morgan is doing, you might scare away some investors. Or if you can nail that, you'll bring in more investors. Maybe they're selling lots of puts, and they're shorting, and or or doing whatever it is they do with their clients to benefit from a down market. Interestingly enough, when I was in grad school, my first economics course was taught by a guy named Walter Fackler, or Bud Fackler, and he was renowned around the country for his accurate predictions. And he came out every year, and people waited for that prediction of what the markets were going to do and what the economy was going to do. And was he right all the time? No, but he was pretty close. What did it get him? It got him notoriety. He didn't own a bank. He didn't run companies. He was a top business school professor for, I think it was like 30 years at University of Chicago. But his sense was, you're probably not going to make a lot of money off of my predictions. So take it for what it's worth. So as we look at this now, okay, you've got your allocation to stocks, you got your allocation to bonds. What do you do based upon this? In general, the median here is about 4.5%. Is that lower than you expected? So you sell off some? I'm not. I'm not doing anything based upon this. First of all, we don't know how accurate they're going to be. An indicator I like to look at, not necessarily act upon, is bank loans. And the St. Louis Fed has a chart on their website of all bank loans and leases. And it's a pretty good leading indicator of where the markets will go. It's not perfect. There is, if anybody knew of a perfect one, everyone would look at it, and the advantage would be gone. But it's a pretty good leading indicator of where the stock market's going. Loans and leases went up a lot in 22, and of course, 23 was a good year for the stock market. If you look at loans now, they kind of peaked last October, November, and they've started a slow descent down. Part of that is the result of interest rate increases, and this is why interest rate increases will sometimes stifle economic activity. So based upon that, I'm not overly optimistic for the stock market for this year. If it were flat to 5%, I guess I would be happy. I wouldn't be happy, but it'd be about what I expect, and I'd settle for that. I think bonds will do much better, especially once the Fed starts cutting rates. But I'm not doing anything. I'm keeping my allocations exactly where they are. If you're just reshuffling your allocations right now, and you had a very high allocation to stocks and you're pessimistic, PEs are very high, the markets are, near record highs, depending upon which market you're looking at, you might say, okay, I'm at 60%, maybe I go down to 55%, maybe I go down to 50, something like that, but nothing drastic. Stay the course. Investing is a long-term thing. I do index funds. If you do stocks, good luck to you. Really difficult to beat the market picking individual stocks. There's going to be people who think they can all the time. Go for it if you can. So that's just my take. I just wanted to update you on what the outlook is. Again, stay the course. Stay invested. Shuffle a little bit if you want to, but it's not something I'm doing. So subscribe, like, share, comment. I'm getting some great comments. I'm getting some great recommendations for videos I can do, and I'm trying to schedule those out and do some research to do those. Some of them take a little longer. Some of them are a little niche or complicated, but I'll get to them. Love your comments. Negative comments are fine. Positive comments are fine. Any comments are fine. Subscribe, please, and I'll see you next time. Bye.